G'day and welcome to the Investor Motivation Podcast. Welcome, Amy.
Hello, Rob. How are you going today?
I'm well, thanks. How are you?
Yeah, I'm very well. Maybe slightly a little bit better than you.
We're talking football now, are we? So, Blue supporter and
a Lion supporter.
There you go.
We
Well
all know the
done.
story there.
You guys were far too good for 3 quarters. We were good for 1, but that doesn't win a game.
Yeah.
Good luck this Saturday.
Thank you. You're the one going to the game, so who's the real winner?
Well, hopefully it's the Brisbane Lions, is it?
Yeah. That's right.
The Brisbane Bears. I've heard that term this week so many times. The Brisbane Bears. I thought, no, hold on, that's a different decade. Welcome everyone. Today we're chatting about listed investment companies. This was a request from one of our listeners, so thank you very much. And feel free to shoot in any topic ideas you would like us to cover, because we enjoy doing it. It is good fun. So today is listed investment companies, which is off the back of the Peter Thornhill Day we had.
Everybody that knows Peter Thornhill knows he is a fan of listed investment companies. From that podcast we've got this request and we are happy to do it. But before we get into that, I might just do the acknowledgement of land. On behalf of the Investor Motivation Podcast, we would like to acknowledge the traditional owners of which we record this podcast and pay our respects to elders past, present and emerging.
Perfectly done. Thank you, Amy. Now, listed investment companies, these things have been about for a long time. We're talking decades, if not 100 years plus. And with so much investment options available, a lot of questions around ETFs, exchange traded funds, and the differences between the two is something we can cover off briefly as well. But how did Peter describe ETFs compared to listed investment companies?
I think there was a bit of a verbal spit on the ground.
So for people that aren't watching on YouTube, just on the podcast, he physically showed his disdain for ETFs with a gesturing of spitting on the ground, which was absolutely hilarious and left us all in the position where we knew exactly what he thought.
No words needed.
He doesn't particularly like ETFs. It's the same reason why I've had a disdain for a lot of managed funds, depending on what tax structure you're invested into. And that is managed funds, which are like ETFs, they're a unit trust that they have to distribute all the income and capital gains. And that's not ideal.
No, it's not. You can't, tax plan around the unknown and you get it on the 30th of June, that's the end of the financial year, you've got no time to do anything to mitigate that tax and
And so even if you bought into one of these ETFs or managed funds, at the 15th of June, each year, you are going to cop all the realised capital gains on the 30th of June that year. So it's a really good structure for fund managers and banks to pile on lots of clients onto one entity. So it's a good money maker.
It is.
But it doesn't take into account individuals' tax outcomes at all.
No.
And it's not to say that listed investment companies do. They are internally taxed at 30% like any other Australian business. But they can
company.
They can choose. They can choose not to pay any dividends. They can choose in a good year to withhold some dividends to make sure they keep it nice and smooth over a long period of time. And I have no doubt when I look through some of the listed investment companies recently doing my research for this chat that they are buy and hold investors. AFIC, Argo and so on, they're buying and holding these businesses for a long time.
I think it's probably worth just quickly backtracking for those that have never heard of a listed investment company or a LIC, so it's LIC, no K on it. We'll refer to those as LICs throughout. But it is essentially a company that you can purchase on the Australian Stock Exchange like any other company, and that company then invests directly into other businesses. So on the stock exchange. Much like a ETF and a managed fund, rather, it's just a company, not a unit trust that you're purchasing.
Correct. And there's more control over with the trust. You have to distribute all income and capital gains each and every year. So sometimes an ETF or a managed fund can have a dividend yield of 14 or 15%, really high, where the listed investment companies have full control over distributions. of
Yep.
what they distribute, what they retain, because companies do not have to pay a dividend if they don't want.
No, and because it is a company, it's a closed-ended structure. So when you are buying and selling the shares, you're buying and selling those shares to other purchasers on the Australian Stock Exchange.
Yep.
Rather than a managed fund. You just purchase directly through the management company, and they can issue as much units out, I guess, as they want
Correct.
to.
Yep, and that's open-ended, so I've said that works beautifully for the business model of funds management, where you just keep adding new units.
Yep.
Where these are, as I said, closed-ended funds where there's only, say, 100 shares on issue, and if they want to create more shares, then they've got to go through a process to do that.
Yeah.
And while we're on that topic, and this is something that Argo does regularly, that they'll offer yearly share purchase plans where you can buy, it was $15,000 for a share purchase plan, it's now $30,000, that you can buy $30,000 and they'll offer new shares at a discount to the current share. And that discount's probably around 2.5%, so it's not huge.
And I guess another really good benefit of it being a closed-ended structure, if you do purchase shares and you want to sell it, well, I guess this is a bit of a con as well. There needs to be a buyer sitting there wanting to buy those shares off you. But it is great for the listed investment company itself, because they can, buy a company within their company. So they'll buy shares in a business within their company, and they don't need to ever sell down their investments in order to fund that seller's wish.
Yes.
Essentially.
Yep. And one thing to watch with listed investment companies and other products, that sometimes the net tangible asset backing can be less, traded at a discount to the share price, or more than traded at a premium.
Yep.
So that's one thing to watch, where it can become there can be an opportunity there. I know there's a few businesses out there that trade well below the actual physical investments within the fund, and that's a BTI, Bailador, which is at the more risky end of the spectrum, where they're investing into startup tech businesses that are scalable. Now they've got nearly a third of their money in cash, a third in listed investments, so you know what they're valued at, and the rest are unlisted assets. But their NAV, their net tangible asset backing, might be $1.60, and they're trading at $1.25.
Yeah.
This is general advice. This is not saying go and buy this at all, but there's this big difference there, and because so much of that fund is either just pure cash is cash, and the other's listed. 2/3 are either cash or listed investments. You sort of know what things are valued at.
Yeah.
So it's a bit odd for it to be trading at such a big discount.
Yeah.
So it all would relate to the unlisted assets.
Yeah.
How are they valued?
Yeah. Interesting.
So that's just one to watch, the discount or the premium to the share price.
Yeah.
One to watch. So there's lots of examples of these listed investment companies, and they're chock-a-block full of, and because they've been around for a long time, they all participated in the floats in the early 90s, so CommBank and CSL and all, Telstra, they're often full of these.
Yeah.
But reading through, and you can go and have a look online and see their top 25. You can see there are a lot of new businesses there that might be a little bit smaller, because one thing that I've probably shied away with LICs is that they are very mature.
Yes, they've been around a very long time.
Yeah, very, very mature, and they've got a lot of the old heads and what I would call a 1990s portfolio.
Yeah.
So you've got 4 banks, Telstra, hopefully there's CSL. If you've got CSL that you bought in 94, happy days, and you never sold, good luck to you, because 80 cents per share is now 250, which I think it's good value at the moment as well, at this price.
Yeah. And it probably is worth noting, listed investment companies are typically more actively managed than an ETF would be. There can be 60 to 100 plus investments within an investment company, which is quite a lot. And they can be quite concentrated with some old stuff, but they do, because they are so active, look for the new up and coming and invest in those as well. Yeah,
I get the feeling that looking at some of the mainstays, AFIC, Argo and Durawarra, that they are buy and hold investors. But as I said, they've got revenue and dividends coming in that's reallocated. They're always raising more capital.
It's probably not so much active in selling out of assets, but just purchasing new ones where they see opportunity.
Right, from a fee point of view, obviously fees matter. I've always, fees affect our net return. What are the fees like on these listed investment companies?
Generally pretty high, I would think. They're normally 1 to 2% for just the management aspect of it, and then they can have the performance fee, which is always the one that hurts.
Yes, yep. So some are high, probably some of the newer ones are high. Yep. Some of the older ones that we mentioned, AFIC and Argo, they're doing it for less than 0.2.
At the management fee?
At the management fee.
Wow.
So they, because they've got scale, they are not expensive at all. So yes, the bail it all one that I mentioned, I think that's at a higher level, not hedge fund world, where they call that 2 and 20, which is 2% ongoing of the funds under management and 20% performance fee.
Yeah.
So that's exactly the scenario you just mentioned. But so some of these older ones are actually quite good value.
Yeah.
But they probably also seem expensive when compared to some of the Vanguard stuff.
Yeah, some ETFs can be extremely cheap.
Yeah.
Or not cheap, but low ongoing management fees.
Yeah. And I suppose if we're starting to compare some of the ETFs, where obviously Peter was reasonably negative on, and it's not our favourite space, but because they're an index fund, they are not trading. They're not creating all these big capital gains, and they're doing it for next to nothing. Yeah. Yeah, because the scale that they have is just so big.
Yeah.
So most LICs are actively managed, whereas ETFs are generally a bit more passively and indexed managed. So they'll just look at the top 200, the ASX 200, and that's what they'll buy.
Yeah. Have you personally ever gotten into LICs?
No. I did use them early on the piece for my clients as good diversifiers.
Yeah.
But I find owning Microsoft or Altium or Pro Medicus, I just find it more fun. I want to know where my money is and know the story behind the business.
Yeah.
And looking at the returns over the last 10 years, they're sort of in line with the index, but mostly a little bit below.
Yeah.
So there's a bit of underperformance there. Now, the ones that I looked at, obviously some of those mainstays, you're not paying a huge fee for underperformance.
Yeah.
But it just seems typical of a 1990s portfolio.
Yeah.
There's some really mature businesses that have been phenomenal for these LICs.
Yeah.
Absolutely phenomenal.
Yeah.
Yeah. But in the last 10 years, not quite, at the index, if not a little bit below.
Yeah. I was just asking because they are a closed-ended fund and you need to have that seller or the buyer to sell your shares. I wonder how hard it is to actually get into these more, legacy older LICs that are quite popular. And
I think to get in and out, because of their size, the liquidity's fine.
Yeah, there's always a seller and a buyer.
And of course, what happened for the last 10 years has got no bearing on what happened for the next 10 years. Because when I started to look through the top 25, and I encourage people to do that. One, to understand what they own, but it's also a bit of a hint and guide as to what businesses have been well researched. These are professional managers that their life is investing.
Yeah, so, I know when we do individual stock selection and we look at the ownership, and if we do see like the Wilson families there or anything like that, it is, they've got a huge team behind them, and it gives you a little bit more peace of mind.
Absolutely. So it can help guide you to also own your own direct portfolios rather than LICs. I suppose Peter's want to go to LICs is just to say, I don't want to have to think about it. I don't want to have to make decisions. I want to go and have fun. Yeah,
and it is, he is a retired man. It is especially attractive for retired people because there is generally, because they have the ability to retain earnings and dividends to then pay out in years that companies may stop giving dividends. It is really attractive for retirees to make sure there's that steady flow of income coming in.
Absolutely. And there's a great story, and this Peter came up with it. This is one that he would have invested into when he lived in the UK. It's a LIC called the City of London, and over the last 50 years, they have consistently increased their dividends over that time.
Yeah.
So 54 years of dividend growth is just off the charts.
Yeah.
And you know, how they do that, well, it's just obviously smart investment, but this is where in good years they can keep a little bit of money back.
Yeah.
They call that dividend smoothing. They can retain some dividends to, you know, to fill in the gaps when you have a COVID event.
Yeah.
You know, companies' dividends did drop because people just weren't trading.
Yeah. Yeah, that's brilliant.
What other areas should we cover off on LICs? I suppose how to buy them. How simple is to buy it? I'm watching my kids, a couple of my children are using Stake on their phones.
Is that just another brokerage?
Just another broker. Just another broker,
Yeah.
which is an app on the phone.
Yeah.
And they can trade for us, you know, the cost is next to nil.
Yeah.
And I know through AussieX, who we've used in the past, it's been a minimum of $500, but I think you can even do less than that. So you can probably go and buy $200. So that thought that you need a lot of money to invest.
Yeah, it's not the case anymore, is it?
No, it's all changed.
Yeah.
So brokerages cost brokerage is very low, and you can get in and out very easily.
Yeah.
Now we are buy and hold investors, so getting in, try to stay invested.
Yeah. And again, benefit of a LIC, they're never in a forced sell position if somebody wants to sell their shares to fund that payout.
Correct. These businesses, you know, will have no debt within them generally. They're very well diversified, and this means that you know, the upside to it, that whilst it may have, you know, be around the index or a little bit under, they're not going to go broke. No debt, well diversified, without you having to worry about it. And I think that's an important point. You get to go and have the fun stuff.
Yeah.
Do what you enjoy.
Definitely one company within that investment might go under, but you're not going to see it, you're not going to feel it. It's, that's nice.
So, Amy, just for our listeners, how do you do your own trades?
I use NAB Trade because I'm with NAB. It all just links up. I don't need to be transferring money about the place.
Great.
It has Australian and international shares, and that's any brokerage on the ASX. You can buy a LIC on. Right,
and so obviously any once you set up a broking account, you're good to go. Is that on your phone or PC?
Yep.
So
yeah.
Yep. So you just don't even need a laptop or computer anymore. It can be all the phone. So it can be an easy start, but we would recommend that you do your own research, because this is general advice only. Go and have a look at what these listed investment companies are doing, and there's a whole range of names out there that that provide these in different strategies. I think Whitefield might be a little bit more of the all industrials, rather than some of the others where there might be bigger holdings in mining companies and the resources.
Yeah.
So, and that's obviously, again, that's the Peter Thornhill way of investing, that it's more industrials and no listed property, no resources.
Yeah.
So Whitefield's a good one there, but AFIC, Argo, Djerriwarrh.
Yeah. And can you buy LICs that are invested in asset classes other than businesses? Like bonds or cash term deposit, fixed interest type?
Good question. I don't believe so. I doubt there'd be a huge amount of value to be added, to be charging a fee for those types of assets. But there could well be, like there is in the ETFs, and we get our research from Lonsec, and I showed Amy the other day that there might have been a bit over 60 LICs that they provide research on, that we can get that as professional advisors and investors.
Mm-hmm.
So there'll be lots of variations, and this is where it gets really nichey. There can be LICs that are investing into overseas. Magellan got some LICs that invest into overseas businesses.
Yeah.
So again, great way to get exposure overseas without using an ETF or a managed fund where perhaps we don't like the structure as much.
Yeah.
Yep.
Brilliant.
Yeah. And I think this is from a key point where an accountant told me many years ago that the unit trust structure, it was always written in their deeds that they could stock redemptions completely.
Yeah.
Now, well before your time, before you were interested, Amy, but during the GFC, when the government came out and said, here is a $250,000 guarantee on term deposits, because people were so nervous, they were worried about even cash in the bank. They said, we'll guarantee each account up to $250 at each bank, at one institution. And that sent some fixed interest, type businesses broke, the first mortgage type businesses, and what it did was, because people were taking money out of fixed interest fund managers, to go and get the guarantee, because everyone was so nervous, they froze these funds.
Yes, there are still some clients that will pop in with a very, very old inherited portfolio, and they might still have one of those assets that are frozen. You can't sell it, you can't do anything with it because
so it's been frozen since 2008, 2009.
Yeah, wow.
So we are 15 years later, and there's still this legacy, and that was stuff that we used to inherit off one of the banks, and I think it was Asgard, mostly, or BT. So that was an interesting one. Sorry, when I say Asgard and BT, that was the wrap account, not talking about the fund manager, not to make anyone feel bad. So that would not happen in this space. There is a conservative way of thinking, particularly with some of these older LICs. So if you want diversification, ease of getting in, and not having to worry about what to buy, I reckon they're pretty good.
What can you comment quickly on the taxation as well, benefit for particularly retired people with the franking credits side of things?
That's a big part of the majority for the ones that are investing into Australian assets. There's a high level of franking, so you'll get your 4.5% dividend plus franking on top of that, which is essentially a return of the 30% tax that the LIC has already paid, and you get that back at tax time. So a 4.5% yield can gross up to say 6.5, which is really healthy.
It is. Especially if you are retired, you run a low income, you just get that refund.
That's right. And you've got to remember, at the end of the day, what's sitting behind these LICs are businesses. Businesses are full of people that are working hard to make their businesses better over a long period of time. So that's what I back.
If you don't want to do the research to select those businesses yourselves, a LIC or an ETF are two very viable options.
Absolutely. Very good. All right. Thanks, Amy.
Thank you.
Very good. Everyone enjoy their Friday off if you're in Victoria, and enjoy the grand final. Good luck to the Brisbane Bears.
Go Lions!
Oh, Lions, my
Fitzroy Lions.
So, exciting to have your team in. Very cool.
And my partner is Collingwood, so it's going to be head-to-head.
So it is on.
It is.
Great. Wrestling in the backyard. Thank you very much for listening. Please leave us a comment. Shoot us through your ideas, some topics. We would love to have a chat about those. And thank you, Amy, for your input again.
Thank you, Rob. Thank you, everybody.
See ya.
Bye.